Bim. Hi guys, Nick Masunda here with my 7th video. In this one I'm going to be talking about passive versus active investing. Obviously I do realise that every man and his dog has done a video on this on the internet, but the message isn't really getting through, it would seem. Definitely amongst layman investors that I know, but even in the financial services world, where you would expect financial experts and professionals to know better, there seems to be a bit of cognitive dissonance as to what the data is telling us on active versus passive investing. So yeah, message doesn't seem to be getting through, so I guess one more video couldn't hurt. Basically what I want to do is just talk about what active and passive investing actually is. Then we can have a look at the performance data on the funds and figure out who the top dog is amongst passive and active investing. So I'm going to start by defining active investing, because this is sort of intuitively what people think of when they think of investing. This is where you would go out and look for undervalued stocks. I'm going to talk about this in the context of stock investing in the mutual fund world, because this is sort of where the dichotomy between active and passive investing started and is pretty pronounced. So yeah, active investing, it's where people would look for undervalued stocks with the belief that eventually the market will realize the true value of the stock and the stock will go up in price, so the investor can realize a gain. Okay, that's essentially what active investing is. So you're doing the research and you're actively looking for these undervalued assets. So that's active investing. Passive investing, this exists in the mutual fund world. Some mutual funds, I should probably explain what a mutual fund is actually to begin with. Mutual fund is basically a business that invests money on behalf of investors. So there would be a fund manager, which is meant to be a skilled person, an expert in finding undervalued stocks and investing them on the behalf of the investors, so that the pooled money can go up it can appreciate at a faster rate than if those investors, those clients, were investing it themselves. So they'll give it to the fund manager, they'll invest it on their behalf, and they'll charge a fee for doing so. So that's basically how mutual funds work. Now, passively managed mutual funds don't do stock picking. They don't take the time to research and to go and find undervalued stocks. They simply invest in line with an index. Okay? Usually in some of the larger companies in the market. And the basic idea with an index fund is that it will match the performance of the market. So the classic example of this is the S&P 500, which invests basically in the largest 500 companies in the US. Okay, so, and that actually makes up for about 80% of the total stock market capitalization in the US. So basically, if your investing reflects the S&P 500, you're going to get a return that matches the market. Okay, so that is the concept of passive investing. Now, intuitively, you would expect that active investing would be passive investing, right? If you get someone who's an expert at researching and picking stocks, surely they can find stocks that grow at a rate that's faster than the market average, right? But this is where things kind of get interesting, because it's not always the case, to say the least. Now, Standard & Poor's has this initiative called SPIVA, where they provide performance data for actively managed funds. And what happens is, typically an actively managed fund's performance will be compared against a benchmark, and the benchmark is usually the index. So if there's a large cap fund in the US, their performance is generally going to be compared against the S&P 500. All right, because obviously if you're paying a fund manager fees to invest your money for you, you want to be doing better than the market. Right? Or you could have just dumped your money into one of these passively managed funds where the fees are particularly low. Probably should have mentioned that earlier. But the passively managed funds, the index funds, have particularly low fees because there's no manager doing all the research, selecting the stocks, taking the time to do that. They're not very management intense. So yes, these actively managed funds where you're paying more fees should justify those fees by beating their benchmark. Now with Spiva, what they're doing is they release data on how many funds are beating their benchmark. So I'll put the table up which summarizes this data on the screen. Now I'm just focusing on the US at the moment here because of the money that is being managed in what they call open-ended funds like mutual funds, exchange traded funds. Of the money being managed, it's like 60 trillion globally, but about roughly half of that is in the US anyway. So that should be pretty representative of what goes on more broadly in managed funds. So basically, yeah, looking at this data here that I'm going to put up, you can see from basically 3 years onwards, the majority of actively managed funds do not beat their benchmark. Okay, the majority do not beat their benchmark, and it's a vast majority. And the other interesting thing about this data is you can see the longer the time horizon, going into 10 years, 15 years, that minority of actively managed funds that are beating their benchmark becomes smaller and smaller. Okay, so this is pretty remarkable data and pretty compelling data, I think. So, and like I was saying, not intuitively what you would expect. So there's probably going to be two groups of people that when they see this data for the first time, react in a certain way. The first group, they're going to go, yeah, that's great, that's awesome. I'm going to go and invest in index funds now. Okay, probably a logical, for the most part, logical reaction. Then there's going to be the group that's experiencing some cognitive dissonance. They're going to have preconceived notions about what is possible in investing in stocks. A lot of people believe that they can invest in stocks and make outsized gains and beat the market and become rich. And that's, not even being hyperbolic. Particularly younger investors who haven't been burnt yet. Right? So if you're a younger investor, the likelihood is you think that you can go and select stocks, beat the market and make quite a lot of money. But this data doesn't say you can't do that, to be clear, but it does suggest that it's harder than we think, right? Picking stocks is harder than what people think. The reason why these actively managed funds are unable to beat their benchmarks on average is because of that, and because they also have to pick stocks with a proficiency that offsets the fees that they're charging, right? So nonetheless, whatever the reason is, the data is clear. Minority of actively managed funds will beat their benchmark. Yeah, look, that's going to probably be a bit of a bitter pill to swallow for some of you. The data's definitely clear. On average, actively managed funds are unable to beat their benchmark, but it's also clear that there are funds that do beat their benchmark over the long term. But it does leave us with a question: do we go and invest in actively managed funds? And if we do, what methodology do we use to select the ones that are going to win over the long term? Okay, that's a very difficult question to answer. I haven't heard a compellingly good answer for that question personally. Or maybe we just invest a small proportion of our portfolio in actively managed funds with the knowledge that we might beat the market, but we might not. So it's an interesting one. But that's pretty much it, guys. Hopefully you found that insightful. And look, thanks for watching.